Silver just collapsed $5 in a single morning. Gold crashed over $200, and Wall Street is calling it profit-taking. But here's what they're not telling you. Right now, at this exact moment, in a secured room in Geneva, Switzerland, a conversation is happening that could detonate the entire commodity market in less than 72 hours. March 1st isn't just another Sunday. It's a countdown. And the institutional players, the ones who control the paper markets, they're using this crash, this panic, this exact moment, to strip physical metal out of your hands before the most dangerous geopolitical weekend in modern history. But why? What do they know that you don't? Welcome back to Currency Archive. You know, if you've been riding with us through this silver surge, through every manipulation, every shakeout, every institutional trap, then you already know we don't sugarcoat the truth here. So do me a favor, old friend. Hit that subscribe button right now. Not for me, but because what I'm about to show you in the next few minutes could be the difference between protecting your wealth and watching it evaporate this weekend. On the morning of February 26, 2026, traders around the world opened their screens to a sight that made no sense. Silver had collapsed $5 in a matter of hours. From its recent high, near $91 per ounce, the metal had suddenly dropped to $86.24. Gold followed the same pattern, falling more than $200 in synchronized fashion. And across every financial news network, the explanation was uniform and simple. Profit-taking, they said, just normal market behavior after a strong rally. Nothing to worry about. But something else was happening beneath the surface, something the headlines were not mentioning. While paper prices were crashing on trading screens, physical metal dealers across America were reporting the exact opposite phenomenon. Premiums were rising, delivery delays were extending, and institutional buyers were quietly accumulating inventory at levels not seen since the 2020 pandemic crisis. The pattern was unmistakable to anyone who understood how commodity markets actually function. This was not profit-taking. This was a shakeout. And the timing revealed everything an observer needed to know about what was really happening. Because February 26th was not just another Thursday. It was exactly 4 days before March 1st, a date that had been circled on geopolitical calendars for months. The deadline that President Trump had set for one of the most dangerous diplomatic negotiations in modern history. In Geneva, Switzerland, American diplomats were sitting across from Iranian negotiators. The subject was Iran's nuclear program. The stakes could not be higher, and the president had made his position crystal clear to both allies and adversaries alike. If a diplomatic agreement was not reached between March 1st and March 6th, the United States would not wait any longer. Military options would move from the planning stage to the execution stage. This was not speculation. This was official policy, communicated through diplomatic channels and confirmed by multiple government sources. The world was facing a weekend that could determine the trajectory of Middle East stability for the next decade. And yet, on this particular Thursday morning, with 72 hours until that deadline arrived, Wall Street analysts were telling investors that silver's $5 drop was simply traders cashing out profits. The disconnect was extraordinary. Anyone with even basic understanding of geopolitical risk and commodity markets knew that precious metals do not collapse during periods of maximum uncertainty. They rise. History had proven this pattern dozens of times. When military conflict threatens major oil-producing regions, when nuclear negotiations approach failure points, when the stability of global energy supplies hangs in the balance, gold and silver move higher, not lower. So what was actually happening on February 26th? The answer lay in understanding the difference between two completely separate markets that most investors mistakenly believe are the same thing: the paper market and the physical market. On computer screens, in futures contracts and exchange-traded funds, silver was indeed falling. These were digital claims, promises to deliver metal at some future date, financial instruments that could be created and destroyed with keystrokes. But in the physical world, where actual metal changes hands, where bars are lifted and coins are counted, the story was completely different. Premiums over spot price were expanding. Dealers were reporting institutional buyers sweeping inventory. Refineries were running at maximum capacity, with order backlogs extending weeks into the future. Shipping delays from major mints were growing longer by the day. The physical market was tightening while the paper market was collapsing. This divergence told sophisticated observers everything they needed to know. Large institutional players, the firms with access to classified geopolitical briefings, the banks with direct lines to government policymakers, the trading desks that move billions of dollars with single decisions, they were using the paper market collapse to acquire physical metal from panicked retail investors at artificially suppressed prices. It was a mechanism as old as markets themselves. Create fear through price action, trigger emotional selling from less informed participants, accumulate the actual asset while everyone else is running for the exits. And the March 1st deadline provided the perfect smokescreen for this operation. Because when geopolitical uncertainty dominates headlines, when war and peace hang in the balance, when the average investor is paralyzed by fear of what might happen over a single weekend, that is precisely when institutional accumulation happens most aggressively. The question was not whether this pattern was occurring. The evidence was overwhelming. The question was why. What did these institutions know about the Geneva negotiations that the public did not? What information were they acting on while retail investors were being told to stay calm? And most importantly, what was the connection between Trump's March 1st ultimatum and the race to accumulate physical silver before that deadline arrived? Geneva, Switzerland, has hosted some of the most consequential negotiations in modern history. But what makes this particular city so valuable to global diplomacy is not what happens in the conference rooms. It is what happens in the shadows surrounding those conference rooms. For every official negotiation that takes place under the bright lights of international scrutiny, there are parallel conversations happening in unmarked offices, private banking suites, and secured communication channels that never appear in any official transcript. The March 2026 Iran nuclear talks were no exception to this pattern. In fact, they represented perhaps the most complex dual-track negotiation architecture the world had seen since the Cold War arms reduction treaties of the 1980s. On the surface, American and Iranian diplomats were discussing uranium enrichment levels, centrifuge operations, and inspection protocols. These were the topics that dominated news coverage, the technical details that nuclear experts debated on television panels. But beneath this public layer, an entirely different framework was being constructed, one that had almost nothing to do with nuclear technology and everything to do with the global commodity infrastructure that keeps modern civilization functioning. Iran occupies one of the most strategically critical pieces of geography on Earth, the Strait of Hormuz, a narrow waterway through which approximately 30% of the world's seaborne oil passes every single day. When analysts discuss Middle East stability, they are really discussing the security of this single choke point. Because if that strait closes, if tankers cannot pass safely through those waters, the global energy market does not experience disruption. It experiences complete structural failure. Oil prices would not rise gradually. They would explode vertically in a matter of hours. And when oil moves that violently, every other commodity market moves in response, especially precious metals. This is where the Geneva architecture becomes fascinating from a strategic economic perspective. The Trump administration had not simply set a deadline for nuclear negotiations. They had constructed a pressure mechanism designed to force Iran into a much broader agreement, one that would guarantee freedom of navigation through the Strait of Hormuz, regardless of regional political tensions, one that would establish permanent monitoring protocols for commodity shipping routes throughout the Persian Gulf, and most importantly, one that would integrate Iran back into the global commodity trading system under specific conditions that served American strategic interests. This was not about preventing nuclear weapons. That was the public justification. This was about securing the energy and commodity supply chains that underpin the entire Western economic model. But here's where the situation became extraordinarily complex. Iran was not negotiating alone. Behind the scenes, two other major powers had indirect influence over how these talks would conclude: China and Russia. Neither country had official representatives at the Geneva table, but both had massive economic relationships with Iran that gave them effective veto power over any final agreement. China imports enormous quantities of Iranian oil through routes and payment systems that bypass Western sanctions. Russia coordinates military and energy policy with Iran across multiple theaters. And both nations have been actively working to establish alternative commodity trading mechanisms that reduce dependence on dollar-denominated transactions. This is where silver enters the equation in ways most market observers completely miss. For decades, global commodity trades have been settled primarily in US dollars. Oil is priced in dollars. Gold is priced in dollars. Major agricultural commodities are priced in dollars. The system gives the United States enormous geopolitical leverage because countries need dollars to buy essential commodities, which means they need to maintain economic relationships with America even when political interests diverge. But China and Russia have been building an alternative architecture, one based on direct currency swaps, commodity-backed trade agreements, and precious metal settlement systems. The Shanghai Gold Exchange operates parallel to London and New York markets. Physical metal moves through Shanghai under completely different rules and price discovery mechanisms, and increasingly, major commodity transactions between non-Western nations are being settled with physical gold and silver rather than dollar transfers. The Geneva negotiations were not just about Iran's nuclear program. They were about whether Iran would remain in the alternative commodity system being built by China and Russia, or whether Iran would be reintegrated into the Western system under American terms. This choice would determine commodity flow patterns worth trillions of dollars annually. It would establish precedents for how future geopolitical disputes get resolved. And it would either strengthen or weaken the dollar's role as the global reserve currency, Trump's March 1st deadline was designed to force this choice. Either Iran accepts reintegration under Western terms by March 6th, or the United States moves forward with military options that would dramatically escalate regional instability. For institutional investors watching these negotiations, the implications were obvious. If diplomacy succeeded and Iran rejoined Western commodity markets, energy prices would stabilize, geopolitical risk premiums would compress, and precious metals might experience short-term correction as safe haven demand decreased. But if diplomacy failed, if military action became reality, if the Strait of Hormuz became a conflict zone, then energy prices would spike beyond anything seen in modern history. Supply chains would fracture, currency volatility would explode, and the demand for physical precious metals as monetary insurance would overwhelm available supply. The institutions that understood this framework were not waiting for clarity. They were positioning before the deadline, using the February 26th paper market sell-off as cover to accumulate physical metal, while retail investors panic sold into the manufactured dip. Because they knew something that was not being discussed in mainstream financial media. The Geneva talks were not going well. There's a moment that occurs in every major market cycle that separates professional traders from everyone else. It is not about intelligence. It is not about access to better charts or superior technical analysis. It is about understanding a simple truth that most people refuse to accept. Markets are not designed to be fair. They are designed to transfer wealth from those who react emotionally to information to those who create the information that triggers those emotions. February 26, 2026 was a textbook example of this mechanism in action. But to understand what actually happened that morning requires looking at market structure in a way that most investors never consider. The silver market operates on two completely different levels simultaneously. At the top level sits the paper market. Futures contracts traded on the COMEX exchange in New York. Exchange-traded funds that claim to hold silver, but primarily hold promises to deliver silver, digital certificates, derivative instruments, financial products that reference silver without requiring anyone to actually touch physical metal. This paper layer is where price discovery supposedly happens. When financial news reports that silver is trading at $86 per ounce, they are referencing prices in this digital ecosystem. But beneath this paper structure exists something entirely different. Actual bars of silver sitting in vaults, coins being minted and shipped to dealers, industrial users acquiring metal for manufacturing processes, investors taking delivery of tangible assets they can hold in their hands. These two markets are supposed to track each other closely. In theory, if paper silver trades at $86, physical silver should be available near that same price. But theory and reality had diverged dramatically by late February 2026. While paper prices crashed $5 in a single morning, physical dealers across the United States were reporting something completely different. Premiums were expanding. A 1-ounce American Silver Eagle coin that normally sold for $3 to $4. Over the spot paper price was now carrying premiums of $8 to $12. Wholesale orders that previously shipped within days were now quoted at 3 to 4 week delivery windows. And most tellingly, institutional buyers were placing orders that exceeded anything dealers had seen outside of the March 2020 pandemic panic. This divergence revealed the mechanism in its clearest form. Large financial institutions were selling paper contracts aggressively, driving the digital price down and creating fear among retail investors watching their screens, while simultaneously, those same institutions were buying physical metal through separate channels at the artificially suppressed prices their own selling had created. The operation required precise coordination. It required algorithmic trading systems capable of executing thousands of sell orders per second. It required enough capital to absorb short-term losses on paper positions. And it required certainty that the physical metal being accumulated would soon be worth substantially more than the current suppressed price. JP Morgan had executed variations of this strategy for over a decade. Between 2011 and 2020, the bank had been caught and fined multiple times for spoofing and manipulation in precious metals markets. They paid the fines, which amounted to a tiny fraction of the profits generated, and continued operating with minor adjustments to avoid the most obvious detection patterns. Goldman Sachs operated differently, but with similar objectives. Their approach involved using proprietary geopolitical intelligence to position ahead of major events. When the firm's analysts had access to classified briefings about Middle East military planning, when their executives sat in rooms where actual policy decisions were being made, when they knew with high confidence what would happen before the public knew it was even possible. That information asymmetry became the foundation for trading strategies worth billions. But the mechanism only worked if retail investors could be convinced to sell their physical holdings during the engineered price drops. This is where mainstream financial media became essential to the operation. On February 26th, every major financial news network carried some version of the same story. Silver and gold were experiencing profit-taking after strong rallies. Traders were becoming cautious ahead of the weekend. Technical indicators suggested the metals were overbought and due for correction. The language was carefully calibrated to sound reasonable, to make panic selling seem like prudent risk management. None of these reports mentioned the Geneva deadline just 4 days away. None discussed the expanding premiums in physical markets. None acknowledged the institutional buying that was happening simultaneously with the paper sell-off. The average investor watching CNBC or reading Bloomberg had no way of knowing they were being positioned as the counterparty to one of the largest wealth transfers in modern commodity market history. Historical precedent for this exact pattern existed in recent memory. September 2024 had seen a nearly identical setup. The Shanghai Gold Exchange experienced a sudden liquidity crisis that sent paper gold prices tumbling while physical premiums in Asian markets exploded to record levels. Western investors panicked and sold. Eastern institutions and central banks accumulated. Within 6 weeks, paper prices had recovered and continued higher, but the physical metal had already changed hands. The wealth transfer was complete and irreversible. Now the same playbook was running again, but this time the stakes were exponentially larger because the March 1st deadline was not a localized Asian market issue. It was a global geopolitical flashpoint with the potential to restructure commodity markets permanently. The institutions orchestrating the February 26th sell-off were not gambling. They were not speculating on technical chart patterns. They were operating with high-confidence intelligence about what was likely to happen after March 1st. And that intelligence was telling them that physical precious metals needed to be accumulated immediately, regardless of short-term paper price movements. The mechanism was elegant in its simplicity. Use algorithmic selling to crash paper prices. Trigger emotional selling from retail investors. Acquire their physical metal at suppressed prices. Wait for the geopolitical event to resolve. Watch physical prices surge as supply constraints become undeniable. The February 26th operation was not about making money on that particular day. It was about positioning for what came next. And what came next depended entirely on what happened in Geneva over the following 72 hours. Every major market shift in history follows the same pattern. First comes the event that nobody believes will actually happen. Then comes the moment when it becomes obvious that it is happening. And finally comes the desperate scramble by those who waited for certainty before taking action. By the time most investors recognize a fundamental shift, the opportunity to position advantageously has already closed. The March 1st deadline represented exactly this type of inflection point, not because anyone could predict with certainty what would happen in Geneva, but because the range of possible outcomes all pointed in the same direction for commodity markets. Consider the three primary scenarios that diplomatic observers were tracking as the deadline approached. Scenario 1, a full diplomatic resolution. Iran agrees to nuclear restrictions in exchange for sanctions relief and guaranteed commodity trade access. The Strait of Hormuz remains open under international monitoring protocols. Regional tensions de-escalate, energy markets stabilize. At first glance, this outcome might seem negative for precious metals. Reduced geopolitical risk typically compresses safe haven premiums. But the second-order effects told a different story. If Iran rejoined global commodity markets, it would flood the system with oil supply that had been restricted for years. Lower energy prices would stimulate economic activity across emerging markets. Increased industrial production means increased silver demand from manufacturing sectors, solar panel production, electronics manufacturing, military applications. All require physical silver in quantities that cannot be substituted. And if the deal included provisions for commodity trade settlement outside traditional dollar channels, as many analysts suspected it would, then precious metals would gain new utility as neutral settlement assets between East and West. Even the optimistic scenario supported higher silver prices, just through a different mechanism than war premium. Scenario 2, diplomatic failure followed by military escalation. This was the outcome that institutional buyers were clearly positioning for based on their accumulation patterns. If talks collapsed and the United States initiated military action against Iranian nuclear facilities, the immediate response would be catastrophic for energy markets. Iran would almost certainly attempt to close or restrict the Strait of Hormuz. Even if the closure lasted only days or weeks, the psychological impact on oil markets would be extreme. Prices would not rise to $100 or $120 per barrel. They would spike to levels that seemed impossible. 200, 300, perhaps higher, depending on how regional allies responded. When oil moves that violently, inflation expectations explode across every sector. Central banks face an impossible choice: raise interest rates into an economic shock and guarantee recession, or accept runaway inflation. Either choice drives investors toward hard assets that cannot be printed or inflated away. Gold and silver have served this function for 5,000 years. They would serve it again. But beyond the immediate crisis premium, military conflict would expose something far more dangerous to the current financial system. The fragility of just-in-time global supply chains. Modern economies operate with minimal inventory buffers. Components arrive exactly when needed. Products ship exactly when ordered. The entire system depends on predictable transportation and stable energy costs. A prolonged Middle East conflict would shatter these assumptions. Shipping routes would be disrupted. Insurance costs would explode. Delivery timelines would become unpredictable. Manufacturing operations that depended on silver-containing components would face immediate shortages. Because, unlike gold, which sits primarily in vaults as monetary reserve, silver gets consumed in industrial processes. It goes into products that eventually end up in landfills, not into recyclable investment holdings. Annual industrial demand exceeds annual mining supply. The deficit has been filled by above-ground inventories accumulated over decades, but those inventories were not infinite, and a supply chain crisis would reveal just how thin the available physical supply actually was. Scenario 3, the most likely outcome based on historical precedent. Partial agreement with ongoing uncertainty. Some framework gets announced before March 6th. Just enough diplomatic progress to avoid immediate military action, but not enough concrete detail to actually resolve the underlying strategic competition. Iran, China, Russia, and the United States all claim victory while continuing to pursue conflicting objectives. The Strait of Hormuz remains open, but under constant threat. Sanctions relief happens gradually with conditions and verification requirements, and the fundamental question of whether Iran integrates into Western commodity markets or remains in the alternative Eastern system stays unresolved. This scenario would create the worst possible environment for paper markets. Ongoing uncertainty, no clear direction, sideways price action that frustrates both bulls and bears. But for physical markets, ongoing uncertainty was exactly the condition that created persistent premiums. Because when the future remains unclear, those who control physical assets have leverage over those who only hold paper claims. Delivery delays extend, premiums stay elevated, and the divergence between paper and physical pricing becomes the new normal rather than a temporary anomaly. All three scenarios supported the same strategic conclusion. Physical precious metals needed to be accumulated before the March 1st deadline, not after. This is what institutional players understood that retail investors missed. The opportunity was not about predicting which specific scenario would unfold. The opportunity was about recognizing that all probable scenarios led to higher physical metal values. When every realistic outcome points in the same direction, the strategic decision becomes obvious. Position before the event, not after. Accept short-term paper price volatility as the cost of acquiring physical assets at the last moment they were still available at suppressed prices. The evidence of this institutional positioning was overwhelming by late February. Vault inventories at major storage facilities were declining despite falling paper prices. Mint production was running at maximum capacity with order backlogs extending into April. Shipping containers of physical metal were being redirected from normal distribution channels into private storage. Derivative markets showed unusual options. Activity concentrated in strike prices far above current levels. These were not the patterns of normal profit-taking. These were the patterns of systematic accumulation by entities with high confidence expectations of significantly higher prices in the near future. The question facing individual investors on February 26th was brutally simple. Trust the paper price signals being broadcast through mainstream financial media, or trust the physical market behavior being demonstrated by the largest and most sophisticated institutional players in the world. One group was telling a story with words, the other was revealing their true beliefs with capital allocation. History had shown repeatedly which signal was more reliable. When paper and physical markets diverge, when institutions accumulate while retail panics, when geopolitical deadlines approach and supply chains tighten, the physical market always wins. Not immediately, not in a way that shows up clearly on price charts the next day, but inevitably, as physical constraints override paper market narratives. Silver's path to $100 per ounce was not about technical breakouts or chart patterns. It was about the systematic revaluation of physical assets in a world where supply chain security and monetary stability could no longer be taken for granted. The March 1st deadline was not the cause of this revaluation. It was simply the catalyst that made the underlying reality impossible to ignore. And for those who understood the mechanism, who recognized the institutional accumulation pattern, who saw beyond the paper price manipulation to the physical market fundamentals beneath, the strategic choice was already clear. The only question was which side of that transfer each individual investor would find themselves on when the weekend arrived.